Good morning and welcome to the IRS Solution Attorney show. I am the IRS Solution Attorney. Sorry for the background noise there. Didn't know the mic was live and had to move a piece of furniture.
Don't worry, nobody noticed. I'm your co-host, Katrina Madewell. Welcome to the show. And I can hardly wait for today's show.
Yeah, today we're going to do something that we don't do a whole lot, and we're going to talk about a current event. As you may know, Donald J. Trump, the President of the United States, last night unveiled, finally, his new tax plan. And I thought we would spend the better part of this hour talking about that because it's fascinating. And it's sure to be controversial,
yeah,
for sure.
And we're here, so feel free to chime in. We're at 888-404-1010. We are live in the studio this morning, and we would love to talk to you. Regardless of what your political party is, we do welcome the discussion. And we will let you share what you think. So 888-404-1010.
Absolutely. And I try to keep my personal politics off of the show. It's not that hard to tell where I stand on the political spectrum if you listen, carefully. But I'm going to say something right now before we even dive in. I have never seen a tax cut that I didn't want. So
yeah, I think everybody would agree with that.
You'll be surprised.
Really?
No, everybody.
I guess if it directly impacts you or your business, I could understand that. But who doesn't like a tax cut?
No, I'm going to go farther. I have never seen a tax cut at any income level for anyone, even people that, or even if it doesn't affect me, that I don't love, because I believe that the government is too big and aren't good stewards of our money. I mean, when you think of the federal government, you think, oh yeah, they take care of our money. They spend it wisely. They spend it in wise ways.
The bigger issue for me, I think, is the imbalance. So the same rules do not apply to the people that get paid by those tax dollars. That would apply to me, you, or even the person listening, and that's what I have the bigger issue with.
Oh, you just made that comment as if you were a seasoned veteran working with the federal government day in and day out for 20 years, like I am. You're right. I mean, there are no rules as far as
and that
concerns
is so
them.
far from the truth.
And, just last week we did the show on the Taxpayer Bill of Rights, right?
Yes.
And we talked about, as we're going through the Taxpayer Bill of Rights, you're like, no, how does that work in real life, Darrin? And I'm like, well, it doesn't. They pretty much ignore that routinely because they're, federal civil service employees. But anyway, let's talk about Donald Trump's tax plan.
All right.
I mean, it's fascinating. I mean,
I've been waiting for this. Like, regardless of who you vote for, whatever, I've been fascinated by the whole thing, and I've been waiting to see what he was going to do.
So the first proposal is that they're going to reduce the number of individual tax brackets down to 10%, 25%, and 35%. Now, there are no details on where the income, lines are going to be for those three brackets. But wow, I mean, that's amazing.
I mean, that makes sense. There was a lot of talk about just the standard deduction. Like, if this is what you make, this is your percentage of tax.
Well, there's that in the plan as well, but I'm going to get to that. But right now, just to give you an idea, there's 7 different tax brackets. Right now, there's 10%, 15%, 25%, 28%, 33%, 35%, and 39.6% is where it tops out. And so, what Trump is saying is that he wants to...
Think about what you just said, 39%. I mean, I don't care how much you make, it's ridiculous.
I'm pretty sure that right before Ronald Reagan took office, the highest marginal tax rate was like 79 or 80%. Does that even make any sense?
No, it doesn't.
And there's people watching on Facebook that I know for sure are like, they're holding their fist up to the screen, and there's probably people listening who are saying, yeah, but the rich don't pay their fair share, the rich don't pay their fair share.
But think about it. If it's 40%, you're going to pay most of the tax.
I have a newsflash for people. The rich pay all the taxes in this country.
Well, don't say all. That's not fair. That's not fair. That's not fair. They pay most.
Okay, when I said all, I meant the vast majority. And we can, and on a break, after the break, we can go ahead and I can get you those numbers. I mean, the numbers are absolutely astounding. The other thing that we have to try to do here is define what in the world does the word rich even mean.
Yeah.
It's rich. I'll tell you what rich means. Rich means the guy who's making a little bit more than you. That's pretty much how the normal member of society defines it.
It's interesting that you say this because you know me. You've known me for a long time. Pat knows me. And you guys know me, like, as a person. And so one of my daughters, I suppose, like, ex-friends, sent a text yesterday that said, we're basically rich snobs. And I'm like, really? Yeah. I'm like one of the most frugal people you could ever meet, and you're going to call me a rich snob? Yeah.
Well, I think there's a difference between being rich and being frugal. I mean, everybody says that what's his name? Warren
Buffett. But
Warren
people
Buffett.
interchange them.
Yeah, I mean, Warren Buffett is a frugal guy. I mean, he lives in the same house he bought in like 1960 or something. And, arguably the richest person in the world. So he's extremely frugal. I think to Warren Buffett, wealth is just a game. I mean, all he's doing,
Right.
he's just playing a game. He's just racking up the points, you know. He has way more money than he needs. But who am I to decide how much money he needs?
Exactly.
You know,
But I don't know, it's just irritating. And it's a whole long story behind it, but one of my daughter's friends wrecked one of our vehicles. And we said, okay, you can pay us back, our mistake. Kind of knew, but, anyhow. That's what happened. So it's just interesting people's perspective, and that was the whole point.
So I want to gauge in some just, speculation here. Just total rank speculation, has no bearing in any facts. And so people are saying, well, where do those three tax brackets that are being proposed, the 10%, the 25%, and the 35%, where are those lines going to be? And everybody, I listened to, a couple hours on the way to the studio today of people just talking about it, and nobody would even speculate where they thought the lines were going to be. So I'm going to go ahead and speculate.
Okay.
Okay?
Because they didn't say in the outline.
They didn't say, Donald Trump hasn't said. So right now, the 25%, the upper part of the 25% tax rate is about $92,000. Okay? To me, as I'm looking at the current tax rates and, looking at this plan, I think that's right about where the 10% is probably going to stop, is right around 92 grand. And if you think about it, in most of the country, 92 grand, this is a household, actually, that's 92 grand for a single person, it's 153 grand for married filing jointly. I think in lots of parts of this country, that's still really middle class. Now, it's not necessarily middle class, it's still middle class in Tampa Bay.
I think it is, yeah.
It's totally still middle class in Tampa Bay. But in New York City, in San Francisco,
It's poverty.
in Chicago, it's not necessarily poverty, but
you're close.
you're struggling.
You're on the border.
Right? So I would suggest that's probably where they're going to put the line. The next bottom line would be about $76,000 for a married couple. I don't know. Maybe that's where it'll be.
Well, think about that. Because what you're saying is they're proposing the bottom 4 tax brackets.
Mm-hmm.
And if they take those bottom 4 tax brackets and they put those together, it's interesting what that might do.
It's going to be a huge tax cut for your average person.
Yeah. But think about that. And it's not for me to speculate which tax bracket voted for Trump. But think about it. I think this would actually impact a lot of people that maybe didn't.
I think you're right. And I think it's...
It would be interesting to see what their thought is, because it was a very interesting election. And there was a lot of Trump haters. There was a lot of...
There's still a lot of Trump
Yeah.
haters. He doesn't make it easy. He doesn't make it easy, just real quick,
Yeah.
He does not make it easy to love the guy.
He's not very likable.
Okay? He's not a real likable guy. He says things off the cuff. He says things that are sort of annoying and might even say offensive at times. So he does not make it easy to love him. I'm not a Trump lover in terms of the man. I think he's
But
kind
I'm
of
just curious if it changes people's bottom line, if their opinion of him will be any different.
It may very well. It may very well. And so then I think the next tax bracket, the 25%, I think that's probably going to go up pretty high. I think it's going to be around $416,000 for a married couple, which is another huge
That's
tax
all of the middle
break.
class and then some, I would say.
Yeah, I would say 400,000 of income, at least in most of the country, you're at the upper middle class level. If you're in Manhattan, if you're in San Francisco, if you're in Chicago, you're still middle class at 400 grand. But in most of the country, I think you're upper middle class. And then I think he's going to reserve the tax bracket for 35%. I think that's going to be pretty much where it is right now. I think it's going to start around at that $416,000 or so mark. Again, I have no...
But think about it. I mean, you're talking about a 5% tax break. That's a big number from a big number.
Yeah, for sure. I mean, it could be huge. And then there's people who are worried, especially Democrats are saying that, this is going to increase the deficit and the national debt and all those types of things. However, it may not. Don't you think that's kind of odd?
Well, what happens is when you put more money back into people's pocket, they spend more.
Not only that, I mean, you're right, absolutely. But not only that, but when businesses have more money, what do? They tend to reinvest and they hire and they grow, and that will stimulate the economy. That's the theory. It worked under Ronald Reagan, and I think it would work again.
It's been a long time. I mean, Reagan was in the office in the 80s.
I think I'm old enough that I can think of Ronald Reagan. I can remember specific things that happened during his administration, but I was a kid.
He's the first president I can remember, okay?
I was in high school, and the economy was booming. There were good times. It started out rough because there was a recession,
Right.
post Jimmy Carter, and within a couple of years, he had us pulled out. And this was basically the blueprint.
We owe ridiculous amounts of money, so it's going to be interesting to see how this whole plan unfolds. But it's going to affect a lot of people, not just self-employed. It's going to affect people that take just the standard deduction, and we'll talk about them when we come back after the break. You're listening to the IRS Solution Attorney Show. We'll be back in a minute.
Welcome back to the IRS Solution Attorney Show. I am the IRS Solution Attorney, Darrin T. Mish.
And I'm your co-host, Katrina Madewell. Just wondering how long Darrin was going to let the music play.
Today we're talking about Trump's new tax plan. It just was revealed yesterday. And so we don't usually talk about current events too much on the show, but today it was just too good of an opportunity
Yes.
to let go,
It's kind of hard to let that one pass by without saying anything or noticing it.
So in the first segment, we talked about the fact that he wants to reduce the number of tax brackets from 7 to 3. And the 3 would be, this is all proposals. It's nothing in stone yet. But the 3 tax brackets would be 10%, 25%, and 35%, which would be a pretty massive tax cut for most Americans, I think.
I just think it's simplistic. The more simple, the better.
Well, you've heard this stat, right? If you, the tax code is so voluminous that if you read it 5 days a week, 8 hours a day, it would take you 80 years to read the tax code.
80.
So
Yeah.
there's nobody alive who's read the tax code, not in its entirety. I have read the part that applies to my clientele and the type of work that I do, but you can't read the whole tax code. And it's
And
silly.
that took his whole career.
And what kind of modern society, modern nation, let alone the world's lone superpower, has a tax system that would take you 80 years to read the code surrounding it? I mean, that's just silly. I think most countries basically have some sort of value-added tax sort of situation, Like up in Canada, the sales tax is like 15%.
Canada's not doing so well.
And I think they have a pretty high income tax too. But I think it's pretty much, in most countries, you can do your tax return at the end of the year on the back of a napkin. I mean, it's just not that big a deal. But people in other countries say they can do their returns in 3 minutes.
Well, here's the thing. There's many, many Canadians moving out of Canada. There's a lot of other countries moving in.
Yeah, well, I've noticed, because if you drive anywhere on the roads during the wintertime,
Here.
at least here in the Tampa Bay area, all you see is Ontario and Quebec
I think we're going to
license
be
plates.
staying at some point.
Well, we love our northern visitors because they come and pay a lot of taxes
Yes.
for us that we don't have to pay, mostly in the form of sales tax. But the second part of this proposal is that they're proposing the doubling of the standard deduction.
That would
which
help
is
most people.
That would help most
Yeah.
people. So let's talk about real quick what we're talking about when we talk about the standard deduction.
Which doesn't apply to me or you,
No,
but I
not
think it would help
usually.
everybody.
But the standard deduction is, right now, individuals can deduct $6,350. American couples can deduct $12,700 from their taxable income. What that means is, that's the amount of money right off the top that you don't have to pay any taxes on, okay?
If you're not self-employed and you don't deduct miles and you don't itemize all that other stuff, you can take that.
And so now, if you're a married couple, 12,700 times 2 is something like 25,000 and change. And so that would be an amount of money that you wouldn't pay any taxes on right off the top. So even if you were in the 10% bracket, 15% bracket, the 10% bracket, the 25% bracket, or the 35% bracket, you don't pay tax on that at all. Now, the reason that you said, Katrina, that it doesn't apply to us is right now, there's a mortgage interest deduction,
Yeah.
right? And so if your mortgage interest deduction exceeds the standard deduction, then most people would do what's called itemize their deductions. And itemizing means that you're going to go ahead and fill out a
Which-
Schedule A.
It's interesting that you say this because the rates have been so low that sometimes it's better for people to take the standard deduction.
Absolutely. Or if, let's do this, or let's think about this. You're in a 15-year, mortgage, and you got a really good rate, say 4 to 6%, somewhere in there.
Lower than that, some of them.
Let's say somewhere in there, but let's say you've got 5 years left on that 15-year note. I mean,
Not much
you're
interest.
paying no interest. So that was one of the reasons why we ended up buying a larger house recently, was because I was inching back to that situation where I wasn't going to be able to itemize my deductions, and so the point of paying the mortgage interest was kind of like there was no benefit.
Yeah, right.
And
You either
so-
want to pay it off and have none or take a bigger one.
Right, exactly. And so, being the tax guy, I decided to take a bigger one, and there's lots of benefits to the bigger house and whatnot as well. But that's what we did. So I think that doubling the standard deduction may have the practical effect of, in lower cost housing areas of the country, it may have the practical effect of eliminating the mortgage interest deduction, which is pretty interesting.
Well, you know who's going to fight that?
Well, hold on, because that's going to be, later down here, we're going to talk about the fact that he wants to eliminate most deductions, but the mortgage interest deduction is still going to be one of those, is going to be a deduction that he wants to keep.
Yeah,
And
and I think he
the charitable donations is the other deduction that he's proposing that we keep.
Both of those
And,
instead.
and the elimination of all other deductions, which is fascinating.
So like for somebody like me, my mileage and everything is gone?
No, because that's gonna be a business expense. It's not
Okay.
really a deduction, that's a business expense. But the one that caught my eye or my attention as I was thinking about this today was, what about the health savings account deduction? Or the self-employed health insurance deduction? I mean, aren't we supposed to be fixing healthcare here? So.
Well, aren't they repealing all of Obamacare?
Yeah, so I don't know. I mean, I still would think that these massive changes would still definitely be better than keeping those deductions in there. But of course, I'm going to be a hog. I want to get fat. I want the cuts, and I want my deduction. I think most physicians would rather have a system where consumers cared what things cost and paid at the time that services are delivered, because right now what they have is a situation where they have to
Chase
bill
money.
and bill and bill and rebill, and it takes them a year to get paid, and then the insurance company, newsflash, cuts the bill anyway.
Is it
So-
Good RX? Is that the app? Or
Yeah,
no?
it is actually. It's Good RX.
That's at the top of the list. since your devices are being occupied. You're listening to the IRS Solution Attorney Show, and if you're just tuning in, we're talking all about Trump's tax plan. His new proposed tax plan just came out, what, yesterday?
Yesterday. And so when we come back, we're going to talk about the fact that he wants to cut corporate tax rates. Kind of controversial.
I think it's going to be good.
I do too.
Of course, because we own our own business. But if you have a say on this and you got something you want to chime in on, we'll listen, and we'd love to have your input. The number is 888-404-1010. Again, that studio call-in line. Pat George will grab your call, 888-404-1010. We'll be back in a minute.
Welcome back to the IRS Solution Attorney Show. I am the IRS Solution Attorney, Darrin T. Mish.
And I'm your co-host, Katrina Madewell. Thanks for sticking with us after the break. Today's show is a little bit different off the cuff, but we're talking all about Trump's plan to cut the taxes, like he's been talking about this since pre-election.
Yeah, so in the first couple segments, we were talking about the fact that he wants to cut the number of tax rates down to just 3, 10%, 25%, and 35%, and that he also wants to double the standard deduction for most people. Those would equal pretty huge tax cuts for your average person, most of the people who are listening to this show anyway. And then right before the break, I teased it a little bit. He also wants to cut the corporate tax rate, which is pretty interesting. He wants to cut it from 35%, which it is right now, to 15%. And that upsets some people, because when people think corporations, what they're thinking about is, General Motors, Ford, Berkshire Hathaway, the really big companies in the United States, Walmart, that's what they're thinking. But this proposal is a little bit interesting, because when I first heard just hints about that he wanted to cut the corporate tax rate, I was like, well, could be good, could be not so good. And it is good, and I'll tell you why. Because he's proposing that this will apply to flow-through entities too. Flow-through entities would be like partnerships, S corporations, your mom and pop businesses that you frequent every day. If you go to an independent coffee shop, that's an S corporation most likely. If you're going to a gas station, most likely, that's an S corporation.
Well, we talked about this over the break too, and there's so many. Most businesses, if you free up cash, they're going to put it back into the business.
Absolutely. I mean, if the way that business owners generally are wired is status quo is never good enough, right? You're always trying to grow. You're always trying to do better.
Right.
You're always trying to leverage what you have and parlay it into something more. And so if you cut the marginal tax rate, then what's going to happen is they're going to reinvest that money. Now, let's say they don't reinvest the money. Let's say they just spend the money. Remember during the George W. Bush administration, there was a couple times where they gave us like some token stupid amount of money, like $500.
Yes, I do.
And they said, and go spend it. And what do? We went and
Everybody
spend it,
spent
of
it.
course. But it wasn't even a blip. I mean, it was nothing. It didn't make any difference at all. You give every man, woman, and child, or every man and every adult $500, and they spend it. It's not really that big a deal. But this is a big deal.
Mm-hmm.
This will kickstart the economy. And when people call me, I don't scare them any more than they need to be scared. In other words, by the time you've decided to call me to get some help with your tax problem, you are already full of anxiety and fear. for the most part. Now, are there people who call and they're like, yeah, whatever, it's not a big deal? Sure, there's some people like that. But
Which you can get, Darrin, by the way, at 888-GET-MISH.
That's 888-438-6474.
Speaking of which.
But I don't believe in that fear-mongering stuff. It's not nice. Well,
Yeah,
there certainly is. At least for right now, there is. And even when this tax plan goes into effect, let's assume it does, there will still be things to fear. Because here's what happens when, and this happens cyclically. I've done this business long enough. I've seen this cycle. Democrats raise taxes and do less to collect them. Republicans lower taxes and do more to collect them. Now, this is a gross, stereotype, right? But as a generalization, that's true. And so that's what will happen, is the tax rates will go down, but they're going to be nastier about getting their money. Now, the other thing that's likely to happen, according to my view, my economic view of the universe or the world, is that when you lower the tax rates, it will stimulate the economy and more commerce will happen. And eventually, within a year or two, I believe tax collections will go up. But the side effect will be more people will be back in the workforce. Because we have this huge number of people in our society. I want to say the number is between 50 and 75 million people who are just out of the workforce, like for good. They're just gone. They can't find a job.
Right.
Maybe they lost their job in 08, or somewhere along the way, and they were on unemployment for a couple of years, and they're just out of the workforce. And that's not right. It's not right to them. It's not fair to them.
Let's not forget, too, that some of your customers might be people that were in that position, and then they started a business to try to gain employment, and then they got in an issue. Because let's face it, it's a special type of person to be self-employed.
Yeah,
you have to pay attention to a lot more details that you don't have to pay attention to when you're employed.
The plumber goes out on his own and starts his own plumbing business because he's really good at plumbing, because that's what he thinks he wants to do, right? He wants to be his own boss. And what you don't realize that when you are your own boss, you spend about 20% of your time doing the thing, delivering the service, whatever it is. And about 80% of the time doing administrative tasks.
Well, building your business, too.
Yeah, building the business, doing marketing, paying the bills. I mean, I wish I got paid for paying the bills, as long as it takes.
So,
as many bills as there are.
And there's a couple of these, Darrin, I really do not want to skip over, so I'm going to make sure we get to them. But I have a question. I'm just curious if you've thought about this or if you read somewhere on it yet. It's probably too early. But they're talking about making all these grand tax cuts, which is great, but there's already a deficit. So where do you think the cuts are going to go? Where is it that's going to receive less money? Because that's the ultimate question.
That's already happening. I mean, the Trump administration is cutting federal agencies across the board. I mean, he's gutted the EPA. And things like that. But I don't know that your premise is actually accurate, because I don't know that a tax cut ultimately is going to cut, in the end,
services,
the revenue to the federal government. This past year, the tax collections were the highest in the history of the United States. The highest in the history of the United States.
Right, but that money's going somewhere now.
And that money's all going down the drain. It's actually a lot of it. I want to say the vast majority of that's going to entitlements, which is a different conversation. When I say entitlements, I mean Social Security, Medicaid, Medicare, those types of things. I'm not making a judgment.
So they're trimming the fat. They have to be.
But I'm all for a government that limits waste, fraud, and abuse. I mean, there's no doubt that there's plenty of waste, fraud, and abuse that goes on in the government. And that's a never-ending battle. You'll never get to the bottom of that.
I think they should start there in the accountability factor before they even talk about tax cuts or anything else. I think if you started there, that would pretty much fix and solve many of the problems.
I really believe that the deficit would probably only go up for a year or two before just the absolute boom in the economy would then catch up, and then the new people back into the workforce and that additional economic activity would produce enhanced tax revenue. I'm not an economist, and I can't say for sure that that's would happen, but that's what happened during Ronald Reagan, and that's what I think would happen in this case too. I think that America, without a doubt, would become the place in the world, the destination in the world for money.
Yeah, I mean, we've pretty much been that place for many years.
We have, but in the last 8 to 10 to 12 years, we've just inched up corporate tax rates. That's why companies like Apple, they park billions of dollars offshore. That money's not in our economy. It's in Ireland. It's in other countries where it's tax advantage to be there. So before we run out of time, and we're getting toward the end of the show here, I want to talk about some of the other things in the tax plan.
We have to talk about the capital gains rate. That's right up my alley.
Okay, so we're talking about they're talking about reducing the
lowering the capital gains tax.
Yeah, just from 23.8 to 20%, which would be great. That would be the top rate. I would like to see, course, I'm not I don't like taxes, right? I would like to see a complete elimination of the capital gains rate. Imagine what that would do for real estate investment.
Oh, yeah.
Now, there's a bad side to
Trust
that,
me,
too.
you could sign me up. I would love that.
There would be a
But
bad
they're
side.
not gonna eliminate it.
There would be a bad side to that too, and the bad side would be the cost of real estate would go through the roof because everybody would be a real estate speculator. I can remember back in like 06, 07, right as things were really cresting, right?
That was December of 06.
When cab drivers are telling you that they're they're buying
Yes.
houses and they're telling you need to do it, you're like, okay, there's a bubble coming because this is.
Oh, yeah.
And I'm not saying anything bad about cab drivers.
No, but there was people, quote unquote, investing in real estate that didn't even know what they were doing.
Yeah, I represent
And then if
many
you
of
ask
those
them if they're planning for capital gains taxes, they're like, what? What's a capital gains tax?
Yeah, for sure. So they're proposing lowering the capital gains taxes as well. But this one I think is a little bit more interesting for most folks, and that is the repeal of the alternative minimum tax, the AMT. The AMT was put in place years ago, back in the 70s, because it was a situation where people were, at that time, rich people, were using deductions to get out of paying any tax at all. And the biggest problem with the AMT law was that it wasn't pegged to inflation, which means at the time, I think it kicks in right around $200,000 of combined income for a married couple. And in the 70s, 200 grand was like a lot of money. I mean, you were wealthy, right? But 200 grand now, we talked about that earlier in the show. I mean, it's like
You're
middle class, right?
Yeah.
I mean, you're like doing well. But if you're in New York City, you're broke. And if you live in some of these big cities, you're broke. And that's one of the reasons why, when you live in some of these high expense areas, that it's really kind of not even fair to them. I mean, because they have to, let's say your apartment's $5,000 a month. So you have to earn a certain amount of money just to cover that. So,
Right.
Anyway. So they're talking about repealing the AMT, which would be really nice because it is a trap that more and more people are falling into every year. And it's really not a fair situation.
I would agree. There's also going to be a repeal of the inheritance tax. That's what they were proposing.
Yeah,
The death tax.
and for the most part, the inheritance tax doesn't apply to most of us. I forget what the exemption for the size of the estate is, but it's pretty good size now. And so what this would do is this would actually be a boon to small business owners and farmers, family farmers in particular.
Right.
If you think about a family farm, not so much in Florida, but if you think about a family farm in Iowa or Nebraska, someplace in the Midwest, I mean, a family farm could be 1,000 acres.
Yeah.
And what's that 1,000 acres worth? Well, it's sure worth more than $1 million.
Yeah.
So that's the thing, is that small family farms are having to be broken up and sold off.
Just to keep it.
Just to keep some of it because of the inheritance tax. And I don't think that's fair, and I don't think most Americans think that would be fair. If Grandpa owned the farm, then, it should pass down to the family. The government shouldn't take their bite.
Grandpa probably was a slave to even get to that. He
Oh,
probably did
yeah.
without a lot of stuff just to get that.
I have a little, terribly tiny farm, and we're not even really raising anything or growing anything, and it's still like a full-time job just to keep it from turning it back into a jungle. So I can only imagine how hard farming actually is.
The interesting thing, too, like there was a stat back in 2014 that America's inheritance tax is actually the 4th largest in the world.
Well,
It's pretty nuts.
we've got this huge government that we have to feed,
Definitely agree, though, with them preserving the deductions for mortgage, interest, and charity. I think it's crazy to eliminate those. I'm glad they're keeping that on the preservation list.
Yeah, if they eliminated the charitable donation, I mean,
There'd be churches in uproar.
well, nonprofits around,
Yeah.
around the country.
I mean,
run
but,
business.
yeah, and they're there to serve a purpose, and those, rightfully so, those deductions should be allowed.
Absolutely. If we want to encourage something, we should allow a deduction for it. That's why I think the
Yeah.
HSA deduction should stay.
You guys have been so quiet today, so if you're listening, come on, call in.
If we've made you mad, call 888-404-1010.
See, you want the haters.
404-1010. I love haters.
I want the
Haters are
lovers.
way more fun than
All right,
people that say.
888-404-1010, we'll be back.
Welcome back to the IRS Solution Attorney Show. I am the IRS Solution Attorney, Darrin T. Mish.
And I'm your co-host, Katrina Madewell. And since we didn't talk a whole lot about IRS stuff today, if you want to reach Darrin, you can get him at his off-air number, which is 888-GET-MISH.
That's 888-438-6474. You can also visit the website at getirshelp.com. You can download the podcast at iTunes, or our app at the Google Store as well as iTunes as well.
All right. Today's show, we actually talked all about the 7 really critical components of the new Trump White House tax plan, because this has been on the agenda and the radar for a while. And if you missed it, you can catch the show in its entirety. I'm sure it'll be blasted all over the news for a while. But want to run through this real quick?
So, well, in the last segment, I wanted to point
We
this
forget
out
one?
about the repeal of the death tax. I was able to look up some stats here at the break. And right now, the death tax applies at a rate of 40% at $5.5 million inheritance for a single person or $11 million for married couples. So a lot of people listening here are like, come on, those are rich people. Like they should have to pay some tax on that inheritance. By the way, I totally disagree with the inheritance tax at all, because all the wealth that was used to create the estate was taxed once already, all along the way. And so it was blood, sweat, and tears that created that wealth. But then again, also when we're talking about inheriting small businesses like, a farm or a dental practice or something like that, and you want to pass that down to your son or daughter, then should the government take a bite out of that and basically ruin the business, ruin the farm? That doesn't make a lot of sense to me.
And they talk about single versus married couples. What happens if one of them dies?
Well, as long as they're alive at the time of the inheritance,
Okay.
that's what matters. But it's also, it's like a war on generational wealth. And it's all part of this, fuzzy talk about how we're going to create more economic equality or something like that. Well, I did not have family, despite the fact that the family's been in the United States since before, since Pilgrim times on one side. I mean, there is no generational wealth in my family, so that's not where I'm coming from at all. But if you were the guy, if you were the son or daughter of the person about to inherit the family farm because, dad lived to be 92 and finally passed away, and you have to split up the 1,000 acres, I mean, that's just not right.
And you touched on something which I really do not agree on, so I have to comment on this, and I'm usually the less controversial one. But you talk about the economic equality. I don't think that's right.
No,
at all.
no.
At all.
Our country was not founded on a basis or the premise that everybody would be equally wealthy.
No.
I mean, not at all.
Equal rights, sure, but not equal wealth. Because there's some people, let's face it, that work a lot harder to gain that.
Well, I think the average person actually confuses the term economic equality with economic or equal economic opportunity.
Exactly.
So
That's
I think
the
that we
key
all
thing.
should have equal opportunities, equal
And we do.
economic opportunities.
Everyone does.
And I think we do. By and large, we do have equal opportunities. Do we have equal education and equal opportunities in all facets of our lives? No, because that's not how life works. Well, it's about that time. It's a time for the IRS train wreck of the week. I asked for a little bit more time today because this is kind of a cool story. I've represented this elderly gentleman, I think he's about 70, for about 10 years now. And that's
10 years?
That's not really a good thing, okay? I love the guy to death. Over 10 years, you kind of grow attached to people, even if they don't always follow your advice.
Was
and
he
do what
one of
they're
your
supposed to
people
do.
that did not cooperate in the beginning and supply all his stuff?
No, he's actually been horrible at cooperation all the way along the line.
Which
But
is why it took 10 years.
But he's a real personable guy. So, and in most of those 10 years, he didn't pay his taxes. Okay, he came into the office with a small tax problem. He probably owed about 50 grand, and now it ended up being $242,123. Okay, so he owed about 50 when he came in. 10 years later, it's about 242 because again, he wasn't paying his taxes. He just totally wasn't taking advice. It was kind of like this. Hey Darrin, poor me, and I'm like, guy, you got to get current. I mean, we talk about that on the show all the time. So.
Finally, you were listening to the show. What happened?
So I finally got him into compliance. It took like the better part of 8 or 9 years to get him into compliance. We got him making estimated tax payments and stuff like this. This is countless meetings with this gentleman. Okay, countless. And
it might be easier just to hire a bookkeeper for him, Darrin.
And I never gave up on him. So we got him current, and then we filed an offer in compromise. Okay, and remember, an offer in compromise is calculated by it's a relatively simple math equation, and it's pertinent to this discussion here. Okay. So what you do is you take your monthly disposable income, multiply that by 12, add in the value of your assets, and that equals the amount of your offer. So I'll give you an example. If your monthly disposable income was $100, 100 times 12 is $1,200. Let's assume no assets. You could sell the case for $1,200, okay? Now, in this particular gentleman's case, when we did that calculation, it came out to about $35,000, okay? So $35,000 on $242,000 is a pretty good deal. Now, there's an exception to that rule that I explained to you. The monthly disposable rule, And that exception is, if there's enough time left on the statute of limitations, and your monthly disposable income is sufficient to full pay within the life of that statute, then the IRS doesn't give you a deal, they just want their money, okay? And so this is what happened, and it's been happening a lot lately, is when the offer specialist wrote back to me after she started working on it, she goes, nope, this is a full pay. She's like, because of that exception, it's sufficient to full pay over the life of the statute.
He had assets? Is that what it was?
No, it was just he had enough arguably had enough monthly disposable income.
Okay.
And so I'm looking at her tables, I'm looking at her work, and I did something I don't do a lot. I just basically appealed to her. I'm like, look, this has just taken me 8 or 9 years to get this guy current. He's 70 years old. I have finally got him on the right track. I said, I'm not taking this line down. We've got to work on this, and we've got to make this better. And sure enough, what I did is I found some problems on the expense side of her equations, and I was able to convince her to make some changes. And long story short, yeah, we had to increase the offer, but not by a lot. It ended up being recommended for acceptance at $36,921. So we'll call it 37 grand on 242. It's not one of those home run slam dunkers, you know. It's not like a penny on the dollar or whatever. It's still, I don't know, that's about 15 cents or something.
I was going to say, in the grand scheme of things.
And here's what I'm most excited about is he's not going to lose his house because he gave them 50% of the value of the house because his wife owned the other 50%. And very wisely, we had her file separate from him going back, 10 years. When he first came in, I said, no, you are not filing with him because you're just going to make the problem worse. But he ended up being able to keep his house, and this is going to smart. This is not going to be easy for him to do. But
Well, I mean, he paid, according to my calculations, he's under 15% of what his tax burden was.
hey, it's a great deal for him. He's 70 years old. The problem's going to be put behind him, and he's going to be able to live out the rest of his life without
Is he
worrying
still
about the
working at
IRS.
70?
He is still working. He's working in construction.
Oh, wow.
70 years old. So he's a hardworking guy. It just took a while to get the message.
Self-employed?
Yeah,
Oh, man.
absolutely. But I love the story. I love the story because we didn't give up. And he didn't give up. And all that way, through that entire decade, he hung in there. He didn't always follow advice, but in the end, he did.
So finally, after 8 years, how did you finally get him over the fence? Was there a tipping point in this whole
I'm
story?
pretty sure I brought a frying pan to work, and when he showed up for the meeting, I just hit him over the head with it.
You beat him into submission. I love it. Well, if you want some of that, you can get Darrin. Just call him. Just saying, 888-GET-MISH. He'll be happy to beat you with a frying pan.
888-438-6474, 888-438-6474.
Well, he'll get you where you want to go. Thanks for joining us this week. We're so happy you're here for this week.
We are out.